This video is going to look at General Electric Corporation through the lens of our earnings and price correlated fundamental analyzer software tool called FastGraphs. At one time, General Electric Corporation was considered one of the most admired and respected of all American corporations, and most of that reputation was built during the Jack Welch tenure as CEO. And then when Jack retired in calendar year 2000, Jeffrey Immelt took over. So what we're looking at here is a fast graph where we're looking at earnings and price only, with the blue line that represents a normal price earnings ratio. The orange line represents the earnings justified valuation line, and the blue line represents how the market has valued that. And as what you can see here is that stock price followed earnings during the first couple of years of Jack's reign, and then stock prices got excessively overvalued just prior to Jack Welch retiring. This will become important later in the video. This is about where Jeff Immelt inherited the company, and of course, as you can see, his earnings record was pretty good also up until the Great Recession, but he also inherited this company when it was excessively. If we look at the same picture in normal scale, we see some really, I think, more dramatic reflections of what I've been trying to explain so far. Here you see earnings growth, the orange line. The green shaded area represents a mountain chart of earnings. We've added now the light blue shaded area, which represents dividends, and we still have the orange and the blue line. But what I want you to see here is how dramatically overvalued General Electric stock became during the infamous irrational exuberant period, and it ended up about here, which is when Jack Welch retired at the end of calendar year 2000 and Jeff Immelt took over. Let's now go back in time and look at what General Electric looked like under Jack's reign. By clicking the review button, I can go back and plot years historically. We're gonna end this at calendar year 2000, which is the period where Jack was running General Electric, and what you can see here is that Jack generated a great job. The last decade of his tenure, he started in 1981, but we only go back to 1992. Jack grew earnings by 13.1% per annum. Then, starting towards the end of calendar year 1995, General Electric's stock price began to get more and more disconnected from its earnings justified value, which is the orange earnings line down here. And as you can see, this is also the period when everybody loved General Electric. And I can remember warning people that General Electric had become excessively overvalued. The price earnings ratio was in the 30s and 40s during this time, especially in the last year, calendar year 2000. But yet, because the price was going up, everybody loved the stock. And of course, Jack Welch was an American hero as a result. In my point of view, I give Jack full credit for generating this earnings record, but I give the irrational stock market the credit, or blame if you will, as you'll see here in a moment, for making the price rise as high as it has. To get the full impact of why everybody loved General Electric during this time frame, let's look at performance that's associated with this graph. Let's assume we invest $100,000 on this first day, 12/31/1991, and hold it till just about the time that Jack Welch retired. What you discover is that $100,000 would have grown to $751,000. That's a 25.1% compounded rate of return, in excess of 13.7, which the S&P had actually achieved. One of the better years then, because remember, this was during the irrational exuberant period. Add dividends in, and I want you to notice that General Electric increased their dividend every year here, and they grew dividends at double-digit rates, probably averaging 12, 13, 14% during this time. So when you add it all up, shareholders enjoyed about a 26% compounded rate of return. But I want to emphasize that Jack only generated a 13% earnings growth rate. Add a little dividend income into that, and that should have been about what the shareholders should have earned. But because the stock price was so massively overvalued here, they ended up doing almost double that number. Now let's look at what General Electric looked like when Jeffrey Immelt took over the company. First of all, the stock was trading in the high 40s, even up into the mid to high 40s. It was only worth around $12 or $14 a share, based on using a Graham-Dodd-Prying or Graham-Dodd formula valuing the stock. But the point is, because the stock was so overvalued, had you invested $100,000 in General Electric in January of 2001 and held it to today, you'd have lost about 8.3% compounded. You'd have suffered an 8.3% compounded negative rate of return, losing almost 60% of your money and dramatically underperforming the S&P. And as a result of this tremendous, underperformance over the last decade, General Electric is now reviled by most investors and people. But the reality of it is most of this negative return, in my opinion, can be attributed to the excessive overvaluation that Mr. Immelt inherited. And of course, Jack created and moved General Electric much deeper into the financial services side of the business, or the services side, away from manufacturing. That generated some great profit growth for a long period of time. However, when the financial debacle hit in calendar year 2008 and 2009, and General Electric stock price, followed the collapse in earnings down, they were also forced during that period of time to cut their dividend. But what we want to move on to here is point out that, currently now they seem to have, righted the ship. Financial services has now been cut in half as a revenue generator. It used to be, it was almost 60% of revenues when Jack retired. Today it's only about 30%, and all the other businesses are on track and starting to do real well. So General Electric has really strung together a couple of really excellent quarters here, and the current consensus of 14 analysts reporting to First Call expect the company to grow earnings at about 15% a year over the next 3 to 5 years. If they are successful in doing that, then the long-term rate of return from these levels is very attractive. If you apply to 15 multiple and they actually hit the earnings target that these analysts are expecting, then this would assume about a $43 stock by 12/31/2016, and including dividends, that would represent about an 18.8% rate of return. So although General Electric did falter and it was considered one of the great American companies, it's at least worth looking into right now to consider that this company may be on track to once again return to its previous dominance, and could be a tremendous investment today if those analysts are correct. You can buy General Electric at a 3% dividend yield, which is actually more than you can earn on a treasury bond, and with the prospects for future growth, it could be a great time to be revisiting General Electric, because now the overvaluation is behind it.